Well, I think, as you just mentioned, it is highly uncertain, and no one has any clue what's happening with the second wave because no one really understands the virus fully at the moment. It's not just an economic questions like where you could have a forecast, etc. It's really the most uncertain environment we probably have seen in living memories for investors. So in that sense, it is difficult, but I think it's still a good time to be in the equity market, but you have to be very selective because what you've seen through this crisis is that some of the trends that we've seen before are getting more and more important, whereas some others some sectors are really suffering. You mentioned before the airlines, you mentioned all the travel industry. And I think for some of the sectors, it's going to be very difficult to recover, but that doesn't mean you shouldn't be looking at equities because some other companies are doing very well through the crisis. So I think it's more probably a catalyst to do more active management rather than passive investments. Because I think just buying an S&P ETF is not going to give you the kind of return you had over the last few years if you look forward, but some of the companies will be delivering thanks to the strong business and the quality of the balance sheet.
So when it comes to being selective and actively managing a portfolio, do you think these future-proof growth stocks actually have further to run? Because we've already seen a lot of money come into this trade since the March lows. But the question here is, have valuations now become too elevated for that trade to remain attractive from a risk-reward perspective?
Yeah, it's a question that has been around for a while. If you think already before the crisis on the technology sector or communication services, some of the internet giants, there was always the question that they were very expensive, but they kept on delivering quarter after quarter, beating the market, coming up with numbers that were not expected. So I think if you think about the business that will survive the crisis, that will be even stronger in the post-crisis world, I think those are likely to continue to deliver on growth. And ultimately, when it comes to equity, what really matters is growth, if you think about the long term. In the short term, it's very much sentiment, it's very much flow, what we see at the moment in the market is maybe the rebalancing. But really, ultimately, you have to think about, is it the right business? Does the management execute it properly? And does it have a strong growth prospect? And I think it's really for that reason that those kind of companies will do well. Of course, there will be moments of profit taking or some excesses, but if you think more about 1, 2, 3 years down the line, those companies should be outperforming the broader benchmark.